Are mortgage rates finally going to drop in 2025, or are we stuck in the 6 to 7% range for years to come? In this video, I'll break down expert predictions, explain what's keeping rates high, and share my take on what might happen next. I'll also give you some tips on how you can get a lower interest rate. If you're thinking about buying a home, this could directly impact your decisions, so let's get into it. If you're not familiar, interest rates are crucial in real estate because they affect affordability, monthly payments, and potentially overall home prices. Interest rates affect affordability because the higher your interest rate, the more your monthly payment is. The more your monthly payment is, that might affect how much house you might be able to afford. It can also affect the overall home prices. If buyers can't afford as much because of high interest rates, that could lead to some buyers staying on the market for longer, so sellers may drop the price of their home to attract more buyers. As of this recording, the average mortgage rates are sitting around 6.5% to 7%. Interest rates fluctuate daily, so keep that in mind. Depending on when you're watching this video, interest rates could be different from what I'm telling you. Interest rates will fluctuate due to economic conditions. We'll go over some of that in just a little bit. Interest rates were expected to fall in 2024, but inflation and the economic strength kept them higher. So what are keeping rates high? This is where the economic conditions come into play. The Federal Reserve's stance is that while they've paused rate hikes, their focus is on keeping inflation in check. They're trying to get inflation down to 2%. They've been trying to do that for a while now, and it's kind of been stuck around the 3% range. That's why the Federal Reserve hasn't dropped the interest rates a whole bunch, because they're still trying to control inflation. If you're not familiar, the Federal Reserve, often called the Fed, is a central banking system of the United States. It regulates monetary policy by adjusting interest rates, managing inflation, and stabilizing the financial system to promote economic growth and employment. Economic growth will also keep rates high. What's happening right now is the labor market is still strong. Consumer spending is making it harder for rates to fall quickly. Now, obviously, we know that some industries are having a difficult time and we are seeing layoffs and things like that, but when we look at the economy as a whole, it's still relatively strong. Another factor that can keep rates high is treasury yields. Mortgage rates closely follow the 10-year treasury yields, which remain elevated. The 10-year treasury yield is the interest rate the U.S. government pays on its 10-year treasury bonds. It's one of the most closely watched economic indicators because it reflects investors' confidence in the economy. Here's a quick breakdown. The way that it works is when investors buy more treasury bonds, prices go up and yields, aka interest rates, go down. When investors sell treasury bonds, prices go down and yields up, or the interest rate goes up. Why it matters for mortgage rates is because mortgage rates tend to move in the same direction as the 10-year treasury bond. If yields rise, mortgage rates typically increase because lenders demand higher returns. If yields fall, mortgage rates usually decrease, making borrowing cheaper. If you've been keeping up with interest rates, I'm sure you've heard last year and even the year before that experts were expecting interest rates to drop to 5% or maybe even lower. Inflation was stickier than anticipated, so we didn't see those big rate cuts. Mortgage rate trends don't always follow the Fed rate cuts. You may have heard in the news that there have been some federal rate cuts. However, that hasn't affected the interest rate for mortgages. That's because of the few other determining factors that we talked about earlier, like inflation and the general health of the economy. Experts are thinking that the mortgage rates for 2025 are going to go as low as the mid to low sixes is what I'm seeing overall. Fannie Mae is thinking 6.4% in 2025, and then in 2026 they're thinking it'll drop as low as 6.1%. The Mortgage Bankers Association is thinking anywhere from 6.3 to 6.6%. The National Association of Home Builders is predicting the rates will fall below 6% by late 2025. Realtor.com sees rates averaging around 6.3% in 2025. I think interest rates will be in the mid-6 range for most of 2025. I think we're going to be seeing 7s or high 6s for a little bit. Maybe it'll start to drop a bit to mid-6s, and then as the summer hits, this is when more people are out shopping for homes. So I think interest rates might go up a little bit just because of demand. Then by the winter of 2025, we'll see interest rates go around 6.5%. Maybe here and there it could dip a little bit below that, but I don't see interest rates getting into the very low 6s, and I don't see it getting into the 5% range at all in 2025. It's possible in 2026 we might see interest rates go into the high 5s, but I'm not too sure about that. I think inflation would have to cool a good bit for that to happen. If you'd like some free resources like an affordability calculator or free homebuyers course, check out my website, workwithdang.com. I can also help you find a realtor in your area. If you're someone who's looking for the lowest interest rate and lowest home price prices, you might find this in September. In August and September, you'll typically see the lowest home prices because homes that have been on the market since the summer and haven't sold yet could cut their home prices because they feel like it's their last chance to sell before winter. I also believe that in September, that's when interest rates will be at their lowest. This is just a guess based on historical data and following trends, but just a little tip. Obviously, it's impossible to time the market. Anyone who tells you they bought at the perfect time probably just got lucky. Some factors could affect these predictions. If inflation slows, rates could drop faster, but we've been fighting this inflation issue for a while. It's taking a long time for it to get down to that 2% that they like to see. I'm not sure that inflation is going to slow down to that 2% range this year. Also, a weaker economy may push rates lower. Obviously, there's some fluctuation in the economy, but generally speaking, right now what we're seeing is it's a stronger economy than it is weaker. However, I do feel like the economy is very unpredictable and it's certainly not stable at this point. Also, political and fiscal policies can impact rates. I don't believe that rates will drop back to 3% anytime soon. The only way that I see that happening is some sort of economic crash or something like that. A move toward 5.5% to low sixes sometime in 2026 seems reasonable at this point, but there are no guarantees. For buyers, should you wait for lower rates? Home prices are expected to keep rising overall. Fannie Mae predicts a 3.6% increase in 2025. Now, I do have to mention here that real estate is hyper-local, so you want to consult your local market because there are some markets where they're probably seeing a rise of way over 3.6%, and there are other markets where home prices are decreasing and losing value. But if you look at home prices nationally, that's where we're getting that 3.6% increase. Proceed with caution when we're talking about home prices because it's going to vary from one area to the next. Higher interest rates means less competition and room for negotiation. There's a theory that you could buy a home now when the rates are a little higher, but you might be able to negotiate the price down a little bit more since there may be less competition. Then there's the expert advice that we hear sometimes of date the rate, marry the home. This means that you buy now and you refinance later when the rates drop. I will caution you here though, I don't love that advice because we don't know what's going to happen with interest rates. We've heard experts saying for a little while now that rates are going to drop significantly in the next few years. I'm not sure that's reality. If interest rates were to drop drastically, that could make it where buying conditions would be more difficult than they could be currently in your market. Again, each market is going to vary. Some markets are still really hot even now, and some that are cooling off, and some have been pretty cold for a while now, and homes are staying on the market for a long time. Ultimately, when you're trying to figure out if you should buy now or wait, you should take a good look at your finances and budget to see if it makes financial sense for you to buy right now. If you were to buy now, you may have less competition and could have more room for negotiation. That's assuming you're in a market that's slowed down. Home prices could continue to rise, so waiting could cost you more in the long run. However, waiting for a potential lower rate isn't a bad idea. If rates fall, you'll get a lower monthly payment, but lower rates could increase buyer competition and how much negotiating room you have. Ultimately, it depends on your budget and timeline. If you find a home you love and you can afford the payment, buying now may be the best move. Ultimately, I think the deciding factor is where you are financially. You want to be stable. I wouldn't recommend taking too many financial risks right now, like buying a home that you're not sure you can afford. Here's some ways that you can make buying more affordable. You could explore mortgage rate buydowns. There are temporary ones and permanent ones. I would talk to multiple lenders to figure out if buying down the rate makes sense for you. Sometimes it makes more sense to put down a higher down payment, and that could affect your monthly mortgage payment more than buying down the rate. If you're not familiar, basically what buying down the rate means is you pay money to buy points, and those points are used to lower the interest rate. A strategy I've seen some clients use is asking the seller to buy down the rate for the buyer. This typically only works in slower markets or when a home has been on the market for a while and the seller is willing to do what it takes to sell their home. You could look for new construction. Some builders are offering different incentives, specifically offering interest rate reductions. Just a caveat there, a lot of times it's only if you're going with the builder's preferred lender, which typically isn't that big of a deal for people. I've seen some rates in the 4% range. This of course will depend on where you live. If you live in a hot market, you may not see those incentives. Another way to bring down your interest rate is with an adjustable rate mortgage. An adjustable rate mortgage means that your mortgage rate isn't fixed, so it won't stay the same percentage for the life of the loan. The reason why someone would do this is with an adjustable rate mortgage, typically the interest rate will be lower than what you could get with a fixed rate mortgage. The downside to this is that your interest rate can go up, and it can go up significantly depending on the terms of the loan. This isn't a long-term solution in my opinion, and I really would proceed with caution. If you're considering an adjustable rate mortgage, I would take a very good look at your finances and maybe think twice. It may not be the time to buy right now if the only way you can buy is through an adjustable rate mortgage. Interest rates not dropping drastically isn't all bad though. I think a silver lining to the interest rates starting to stabilize is that it can also stabilize the housing market a little bit as far as home prices go. I think in a lot of markets we're going to see moderate price growth instead of these rapid spikes like we did just a couple of years ago. Because of this, it could improve inventory levels. You might see more homes on the market or more inventory than you've seen within the past couple of years. It's also possible that homeowners who've been waiting to sell until interest rates get low again might start to realize that interest rates may not be getting as low as they'd like anytime soon and may consider selling sooner rather than later. Ultimately, before buying a home, I think it's best to take a good look at your budget to make sure you feel comfortable making such a big purchase. Analyze your local market because each market is going to be different. What do you think will happen with mortgage rates? Drop your predictions in the comments. Like and subscribe if you find value in this video. Thanks for watching.